Hey guys, what's up? I'm Erin and welcome back to the channel. Imagine handing your teenager keys to a brand new car and in the process, accidentally setting them up for a lifetime of unrealistic expectations. Well, this is exactly what financial guru Dave Ramsey warns against. He states the best thing to do for your kids is to have them buy their own cars. When you buy new cars for teenagers, you're setting them up for a life of ridiculous expectations. Think about their future. If you have enough cash set aside, you and your child could agree on a matching plan to help buy the car. Whatever your child saves, you'll match. Whether or not you generally agree with Ramsey's advice, this advice has sparked some serious debate. But I think if we back it up, we can put this context into a more broad question. And that question becomes, should you buy your kid everything? Buying them everything, does that set them up for a lifetime of financial hardship? And I would argue, yes. In the beginning, children are naturally dependent on us. For example, I have a 14-month-old son, and right now, everything he has, he was given, just as it should be. There comes a point when children need to learn that everything has a cost, and in order to earn money, you have to sacrifice time, and both time and money are limited resources. So teaching them to weigh their purchases carefully help them to understand this trade-off of time and money. And it is really important that the financial education be appropriately tailored to the age of your child, which might look something like this. At ages, say 3 to 5, focus on play-based learning, introducing money through counting and simple exchanges. This might also be a good time to introduce the concept of a want versus a need, maybe talking about toys versus food, but you do want to keep it fun and keep it simple. As children tend to get older, maybe in the 6 to 8 range, you can start to introduce the concept of earning money and saving money. I really love the idea of being very visual with money with kids, so actually using dollars and coins so they can really see and feel the money. This was also the age where my parents started to introduce an allowance, and it was tied to chores. So I learned to associate work with earning money. And my parents did tie our allowance to our age. So I was eligible to earn $6 a week when I was 6 years old, assuming my chores were completed. Again, this reinforced the idea of earning through effort. Initially, in my childhood home, the whole concept of money was taught at home. So I was given the money, I would count it, I would keep it in a jar at home. And then later in life, I believe around the age of 8, we started taking this money to a bank and I would make a deposit on a weekly basis. But I physically had the money that I would take to the bank. I also think this is a really great age to start introducing the concept of delayed gratification. If your child has a toy they want to buy, teach them the concept of delayed gratification by having them save up to buy this toy. So once they have enough money, actually bring them to the store and allow them to hand the money to the cashier. I really think this physical act helps to cement the concept in their mind. But even simple tasks like this are getting harder and harder to do with so much of our shopping moving to the online space or the move to debit cards and credit cards. So we're not really physically parting with money. But I do think this is really important for children in the learning process. As your kids get a little bit older, maybe in the 9 to 12-year-old range, you can start to dig a little bit deeper into finances. I know I said my mom brought me to a bank at a younger age, but I think if you want to wait until 9 or 10 in order to bring your child to a bank, I think that's totally fine. But I do think it's important to get them introduced to the concept of banking and interest. I also think this is a great age to help them start tracking their finances and teach them about goal setting, teach them about short-term goals and long-term goals. I was an odd little child who was already obsessed with investing at this age. It certainly didn't make me a cool kid. Maybe it gives me more cool points as an adult. That's debatable, but it certainly did not make me a cool kid. But I do think this is the age where you can start to introduce the concept of investing and going over what interest looks like and saving for the long term. I also think you can introduce the concept of budgeting and living within your means. As your children become teenagers, I think this really gives you the opportunity to start to drive home the value of money. At this point, you might start talking about comparison shopping and using your dollars wisely. I also think this is the age where kids really have the opportunity to tie money and time together at a more deeper level. Because so many children tend to get their first jobs when they're in this age range. So they can start to see the true value of money as they start to exchange their time for it. And it can really help them to make smarter financial decisions in terms of how they spend their money. I also really love the idea of getting children of this age involved in household finances. Maybe teaching them what it costs to run a household on a monthly basis, showing them when you're planning a vacation what that costs, maybe helping getting them involved in planning the vacation. I think the more actively involved they get, the broader their knowledge base becomes. And this is really the age where Dave Ramsey's advice at the start of the video comes into play. And this philosophy does really align with how I was raised. In my mom's view, I had to save up half of everything I wanted when it came to big ticket items, and she would match the other half. And I really thought that this taught me to value what it was like to work and save for something that I wanted. One of the first standout purchases in my mind where my mom implemented this rule was K2 rollerblades. And I distinctly remember this because these rollerblades were $100, and I asked my mom for them, and she said, sure, if you save up $50 for them, I will match you $50 and you can have those rollerblades. I was so into rollerblading back in the day, but fun fact, I still am to this day. I saved up the 50, my mom gave me 50, and I got the rollerblades. She always said that this was a great way to gauge if I truly wanted something, because sometimes she would tell me I had to save up half of the item's value, and then she would match me, and then I would come back and say, oh, well, I don't really want it that bad, and then she would say, well, then I guess you're not getting it. So I am a huge proponent of having your child meet you partway on the cost of certain items. I really think it helps to teach them the idea that items have a cost. And they ask the question, are you willing to pay this cost? Are you willing to work and trade your time and save up this money to buy this item? I think it's a valuable lesson, and it is something that I plan on using with my child when he gets older. I think by the time children are 16 to 18 years old, this is really the launching pad for real life. This is really where you go in depth in a budget and creating priorities in your life, making sure that you have the money necessary to cover your wants and your needs, and that you're setting something aside for saving and investing. It's where you go over proper usage of a credit card or a debit card. You ensure that they understand the power of compounding interest and making sure that it's working in their favor and not against them. It's where you go over all the true costs of debt. You go over student loans and the drag they can create on you as you start your career, what it's like to buy a big ticket item like a vehicle, and how to assess what vehicle you could really afford. Again, this is the age where Dave Ramsey's advice, specifically mentioned at the top of this video, really hits home. That advice of just don't buy your kid a brand new car outright. And I can say that this kind of reflects my own experience again. At 16, I was able to borrow my dad's car, but I wasn't given one. Later, at the age of 21, right as I was graduating undergrad, my grandparents came along and they said that they would help me purchase a car, that they would pay 50% of it, up to a car of $20,000. I did end up going $3,000 over budget, and I made this persuasive argument, I'll pay the additional $3,000 and I promise I'll drive that car forever. And 17 years later, I'm still driving that car. I keep my word. Now, ultimately, my grandparents were beyond kind, because on the day it came to actually buy the car, they surprised me. And rather than paying 50% of that $20,000 limit, they paid a full $20,000. And this was a great blessing. They said that they were very proud of me for saving up my half and that I should continue saving for a down payment on a home. As I said, today my car is 17 years old, which means it's basically old enough to drive itself. So essentially it's a Tesla, just without any of the features of a Tesla. But I do mean it when I say I truly love my car. I love driving it, and I hope I get to drive it for many years to come. I will drive it as long as it wants to be driven. And a huge part of this is that I acutely remember the pain of having to save up for that purchase. Yes, inevitably, I didn't have to part with the money, but I remember working and saving in order to be able to afford that, and so many other purchases before that car that my mom had me save up 50% for. Having parents or grandparents help with big purchases is a blessing, but it's essential that children have skin in the game. Saving for big purchases teaches invaluable lessons. It teaches you to be cautious with debt. It teaches you to value what you earn. It teaches that effort and sacrifice go into saving. It teaches financial discipline that is worth far more than any item you could ever buy. And it's probably worth touching on 18-year-olds and beyond. As your kids move into young adulthood and start their own lives, I still think you should continue to be a guiding resource for them. You should guide them through big decisions that they're encountering for perhaps the first time or maybe the 10th time, like renting, buying a home, avoiding lifestyle creep, and managing debt. A financial education is one of the best gifts you can ever give your child, and it's the start of generational wealth, whether you actually have money to pass on or not. A good financial foundation sets them up for a lifetime of financial success. Good habits started young pay dividends throughout their entire life. When did you start teaching your children about money? Share your thoughts in a comment down below, or what's the biggest lesson that your parents taught you about money? I'd love to hear. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Brand new. I can't stop hitting the mic today. So close. Okay. Initially, slow down. Jeez, oh Pete's. Okay, I got this right here, right now. Gonna be the best. Okay. At this point, you might oh my gosh, stark is not a word. Why do I keep saying it? Comparison shop. What the frick? I'm broken today.